Another thing I love about real estate is the tax benefits. Now, tax benefits can change. We can't rely on tax benefits as an investment vehicle, but it's important to be aware that over many recessions, some of the same tax benefits are there, and they may not be going anywhere because a lot of our politicians own real estate, and perhaps that's why they protect it. I'm not sure. Whatever the reason that we have, there are excellent, excellent tax benefits to real estate that you can't get in any other investment that I know of. So let's start with, well, first of all, if you don't have a good tax savings vehicle, you're going to be paying 35% to the federal government, another 9% to the state, depending on what state you're in. If you're in Texas, you don't pay that, or Florida, Nevada, but in California, you're going to pay that. Estate tax, well, that changes every year, but you've got the gift tax, local property tax, sales tax. We pay a lot in taxes. So wouldn't it be nice to legally be able to avoid some of those taxes? And that's absolutely possible with real estate. So let's look at how. A lot of people buy real estate as a primary residence for the tax benefit. And that's fantastic. You do get your interest deduction. But that's kind of it. That's all you get as you own that property. So I often say to people, consider investment property instead and rent your primary if you live in a high-priced market. I just had a friend buy a $900,000 property in Berkeley, and there were multiple offers, lots of people trying to buy real estate in high-priced markets because the prices are down, but they're still high. So she just bought her first home, $900,000, but she could rent a similar home for about $4,000 a month. So when I do the math and say, all right, if you took that $900,000 that you spent on your primary and bought investment property instead, you would be bringing in around $9,000 to $10,000 a month. So you could rent the house that's just like the one you bought to live in, pay the $4,000, and now you have $5,000 or $6,000 left every month to spend. So I'm a big fan of renting in a high-priced market, like in parts of California, or like where I live in Malibu. It's crazy to buy there, unless you're going to stay a really, really long time and have enough spare change that you don't need any extra money. Then it's fine. But on top of that, you also get far better tax deductions by owning rentals. You get to write off the mortgage interest plus the property taxes, plus the insurance, plus the maintenance, repairs, professional fees, your accounting fees, your legal fees. These are all write-offs that you would not get on your primary. Education, coming to our events, those are all write-offs. Travel to and from your properties are write-offs. So the deductions on rental property are far, far better than on your primary, which a lot of people don't realize. In addition to that, you get depreciation. Now, you definitely got to talk to your CPA, because if you make over $150,000 a year in combined gross income, you may not get this deduction now. You would be moved forward to use in the future, but you wouldn't be able to use it if you earn over $150,000, which a lot of couples do earn more than that in California. But if you do have losses, and lots of people have losses, you can take the deductions against that. So always talk to your CPA to understand how this applies to you. But if you earn less than $150,000 combined gross income, then you can depreciate the property, which means the IRS lets you write off the house as if it were worth nothing in 27 and a half years. And I have no idea how they came up with 27 or the half, but that's what it is. 27 and a half, your property is no longer worth anything, which, is that true? Of course not. There's properties that are hundreds of years old. My husband grew up in Boston in a 200-year-old home. It's worth something, a lot actually. It's worth lots of money. So for some reason, the IRS does this, and it's kind of strange, but I like it. So let's kind of explain how it works. You're not allowed to write off the land because that doesn't depreciate. Land is land. It's the structure that depreciates, at least according to the IRS. So if you had a $100,000 property, you would have to deduct the land, which might be about 20%. So you'd have to be left with $80,000 that would depreciate. And you would divide that $80,000 by 27.5, which is $2,909. That would be your annual deduction for depreciation expense. So it's great. Based on your tax bracket, you save yourself a lot of money, and that gets added to your cash flow on that property. And then lastly, there's the 1031 exchange. That is, as you know, a wonderful vehicle on your exit. So usually when you sell an investment, let's say you buy gold or you buy a stock, and it does really well and you make a lot of money, and then you sell that stock, you have to pay capital gain taxes, of course, right? What if you didn't have to pay those capital gain taxes? Wouldn't that make it a lot more attractive? Absolutely. So with a property, if you're a landlord and you own a property and you sell your property and you have a big gain on that, as long as you buy a replacement property of the same value or more with the same amount of debt or more, then you do not have to pay that capital gains. You are deferring it. And you can keep doing that until you die, and then your children inherit the property at a stepped up basis and then do not have to pay that gain because now it becomes market value. So this is actually how I got into real estate. Was my father owned an apartment building. The apartment building sold. He had 45 days to identify a new one. He actually had been out of town, so when he got back and found out, he had 30 days and counting because he was kind of procrastinating. And finally he called me and said, I need a property now. Can you help me? And I wasn't in real estate at the time, but I liked looking at houses. So I said, sure, I'll help you find something. And then I said, well, I'm just newly married. I think we'd been married maybe a week. It was like not very long. And I said, why don't Rich and I find that replacement property? We'll live in it. We'll pay everything, so you don't have to worry about this property, and you can come see it and visit it all the time because we'll be living there, and enjoy this, investment. And then, when he passes away, we would inherit it and avoid all those taxes. Or those taxes would just disappear, which is exactly what happened. So it was a win-win situation where we got into our first home. My dad saved from paying the taxes. We lived in it for 10 years. When he passed away, we inherited it. And that property had gone from $500,000 to $1.8 million in that time period. Now, that was at the peak, so it went back down again. But if we had sold it at the peak, we would have made money. But guess what? We didn't. So anyway, if you know how to sell at the right time, then it works well. Either way, this is a great tool. If my dad had bought us property or gifted us, we would have paid a lot in taxes. We would have paid all his back taxes. So again, I don't know any other investment that gives you the tax advantages that real estate does.